Yesterday, the European currency dipped against the US dollar, weighed down by downbeat data from Germany and the euro area. The ZU Economic Research Institute's Economic Sentiment Index for Germany turned out to be above the previous month's value, but remained in negative territory at minus 11.4 points. The index of current conditions in Europe's biggest economy declined sharply, hitting a three-year low of 79.4 points. The Euro's Economic Sentiment Index worsened to minus 8.9 from minus 5.5 recorded in August. All this signals big challenges in the European economy, especially given that the European Central Bank intends to raise interest rates further. According to Reuters, inflation in the euro area is expected to stay above 3% next year. The forecast heightened expectations that the ECB would deliver one more quarter percentage point interest rate hike at tomorrow's meeting before taking a pause. Against this background, the euro bounced back but failed to break above its weekly highs. Now let's take a look at today's macroeconomic calendar. All eyes will be on US consumer prices. The CPI is forecast to climb by 0.6% in August. On an annual basis, economists are estimating a 3.6% rise in inflation compared to the prior month's reading of 3.2%. As expected, this will force the Federal Reserve to keep lifting rates. Also, it's worth paying attention to U.S. core inflation, which excludes volatile items such as food and energy. Core consumer prices are estimated to increase by 0.2% month-on-month. In the 12 months through August, the core CPI is anticipated to rise by 4.3%, following a 4.7% gain in July. If figures are in line with average analyst estimates, a rise in headline inflation will be offset by a decline in core inflation. However, it is difficult to predict the market's reaction to such an outcome. After all, it may also allow the Fed to take a wait-and-see approach to monetary policy at its September meeting. Alternatively, a rise in all inflation readings will leave the door open for another rate increase next week. In this case, the greenback is expected to gain value against risky assets. What's more, traders may take notice of data on industrial production for July in the euro area. The indicator is forecast to decrease, which may put downward pressure on the euro. Furthermore, the UK is set to report data on gross domestic product as well as industrial and manufacturing production. Britain's economy is expected to shrink by 0.2% in July. British manufacturing output and industrial production are likely to decline as well. All this signals that the country's economic growth is stalling amid high interest rates. Yesterday, some Bank of England members expressed their need to raise interest rates further to combat inflation. Last week, Bank of England Governor Andrew Bailey advocated for a pause in the rate hiking campaign. Such contradictory statements from officials add to investors' uncertainty. That's why the British pound is losing value against the US dollar. And now let's move on to technical analysis. According to the 1-hour British pound American dollar chart, the level of 1.2471 acts as support. Much will depend on the market's reaction to GDP data. A false breakout at this mark will create a buy signal, thus pushing sterling up to 1.2526. If the price consolidates above this level, the British currency will have a chance of climbing to 1.2581 and 1.2626, where I recommend going short on a rebound. In case of a negative response to UK statistics, the price may break through and fix below the support level of 1.2471. Thus, the pound sterling will dip to 1-month lows, 1.2419 and 1.2395. At these marks, it would be a wise decision to go long on a rebound. Speaking of the European currency, a false breakout at 1.0733 will make it possible to buy the pair in an attempt to drive it up to 1.0767. If the price stays firm above this mark amid weak US inflation data, a strong buy signal will be generated. In this case, the euro will surge to 1.0798 and probably 1.0825. At the level of 1.0825, traders are recommended to go short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.0767 and 1.0798 can be considered only amid a false breakout. As an alternative, if bears break below 1.0733, the euro could face a major sell-off, diving to 1.0700. Its breakout is likely only if US inflation accelerates. If so, the way to 1.0665, 1.0637 and even 1.0595 will open. Going long against the trend on a rebound will be relevant only at around 1.0637 or 1.0595. Long positions amid a false breakout can be opened at 1.0700 and 1.0665. However, this scenario is possible only if US inflation readings meet expectations, which will enable risk assets, both the euro and the British pound, to hold steady at 1-month lows. Best of luck.